Subscribe to our YouTube channel and press the bell icon to get the latest updates.
Hello everyone, this is Yazid. Thank you very much for being here today. In last week's video, I had spoken about how war or a crisis has historically been a good opportunity to buy quality stocks for long-term investors. Today, we are going to dig deeper and look at 4 fundamentally strong stocks that have corrected sharply that you could add to your watch list. War is never pleasant for anyone. Since stock markets despise uncertainty, key indexes of the Indian stock market, the Sensex and Nifty, have plummeted by over 13% from the peaks in January. Adding fuel to the fire, looming concerns over the sky-high inflation, heavy selling by FIIs, Fed rate hikes, supply chain disruptions, geopolitical tensions, combined with rising crude oil prices, have kept markets on the edge. There is no doubt that shock and fear are the top emotions in the market right now. Investors and traders alike are fear. Sentiment has taken a huge blow. While such corrections cause panic, they also provide long-term investors a window of opportunity to diversify their portfolio and load up on beaten-down quality stocks. Investors are therefore encouraged to use this crisis as an advantage and gradually build up long-term holdings in quality companies. In today's video, we list out 4 fundamentally strong stocks to add to your watch list. First up on our list, we have IndiaMART Intermesh, the first and largest business-to-business digital marketplace in the country, today stands out as a game changer on the B2B landscape. The company provides B2B and customer-to-customer sales services via its web portal. It focuses on integrating the small and medium businesses into a fast-speed and easy-to-use platform. The firm commands nearly 60% market share of the online B2B classified space, which makes it the largest player in the industry. It has a portfolio of 6 million supplier storefronts, 102 million registered buyers, and a total traffic of 748 million repeated users. IndiaMART reported consolidated revenues of Rs 1.9 billion in the December 2022 quarter, a growth of 8% year-on-year. This was driven by improvement in realizations from existing customers and an increase in number of paying subscriptions. Its profit before tax was at Rs 930 million and net profit stood at Rs 700 million, representing margins of 44% and 33% respectively. Moreover, the company is almost debt-free. It has delivered good profit growth of 52.1% compounded annual growth rate over the last 5 years. Over the past few quarters, the company is undertaking investments in manpower and talent retention to fuel growth. Moreover, it has been actively executing acquisitions over the past year. IndiaMART has recently invested in RealBooks, Busy Infotech, Vyapar, Legistify, FleetX, and Shipway to add to services like bookkeeping, inventory management, invoicing, and logistics solutions. These acquisitions will allow the company to scale up its business faster going ahead. Since the beginning of the year, shares of the company have been under pressure. The counter has corrected by close to 40%. The second company on our list is Manappuram Finance. Manappuram Finance is an Indian non-banking financial company based in Kerala. It provides a wide range of fund-based and fee-based services, including gold loans, money exchange facilities, housing loans, and commercial vehicle loans. Manappuram Finance has an extensive branch network of over 3,500 branches spread across 28 states of the country. Recently, the company announced a weak set of numbers during the third quarter of the financial year 2022. It reported a nearly 46% decline in its net profit at Rs 2.6 billion as against a net profit of Rs 4.8 billion in the year-ago quarter. Manappuram's results were impacted due to a shift from high-yield to lower-yielding gold loans coupled with increasing costs on account of aggressive marketing efforts and ad spends. To reclaim a lost share of high-ticket client base and compete with peers, the firm has changed its business strategy and reduced the yield, which has impacted the margin. Due to this change in business model, gold loan asset under management of the company increased by 9% quarter on quarter, but the yield is lower, which has impacted the spread and profitability. However, over the last 5 years, the company has delivered good profit growth of 37.3% CAGR and has a strong return on equity track record for 3 years of 26.11%. The company has a good dividend track record and has consistently declared dividends over the last 5 years. Over the last 1 month, the share price is down by 27%, and over the last 4 months, the stock has lost over 65% of its value on the BSE. Next up on our list is IOL Chemicals and Pharmaceuticals Limited. IOL Chemicals and Pharmaceuticals is a leading pharmaceutical company. It's a significant player in the specialty chemical space. It serves the domestic and export market. The company manufactures various APIs for various therapeutic areas such as pain management, anti-diabetic, anti-platelet, anti-cholesterol, and others. Is the largest producer of ibuprofen with 35% global share and the only company worldwide being backward integrated for all intermediates of ibuprofen. Its products find application in industries such as food processing, flexible packaging, pharma, chemical intermediate, textiles, ink, paints, and pesticides. Since 2019, the company saw significant increase in profitability margins, primarily due to expansion in the manufacturing facility amid supply constraints leading to increased demand of its 2 major products, that is ibuprofen and ethyl acetate. In the past 5 years, the small cap pharma company has delivered good profit and sales growth of 67.4% and 28% CAGR respectively. Moreover, IOL Chemicals has delivered 41% dividend growth per year on average over the past 2 years. On the other hand, the company's margins declined to 10.7% versus 30.7% on a year-on-year basis. Its profits also declined by 65% at Rs 400 million due to weak operational performance. However, the company is confident of delivering 15% earnings before interest and taxes numbers on a sustainable basis. It's likely to see an improvement in top line and bottom line of non-ibuprofen business according to a report. The company has been thrashed in recent times and is significantly off its 52-week high of Rs 725. Finally, on our list is CEAT Limited. CEAT, established in 1958, is one of the largest tyre manufacturers and is one of the fastest growing tyre companies in India. In the year 2020, CEAT ranked 35th among India's 100 best companies to work for by the Great Place to Work Institute. It was recognized as one of the best companies in the auto and auto component industry. The company exports to 90 plus countries, which are categorized into 7 clusters for ease of operations. The tyre manufacturer has established relationships with major original equipment manufacturer companies like Tata Motors, Ashok Leyland, Escorts, Mahindra, Maruti, Hyundai, Kia, Volkswagen, Honda, Royal Enfield, and Bajaj. CEAT key revenue segments include automobile tubes, scrap, other operating revenue, and royalty income. Presently, the trucks and businesses category contribute a majority of its revenues. For the quarter ended December 2022, the company reported a consolidated total income of Rs 24.2 billion, down by 1.6% from the last quarter. It reported a loss of Rs 200 million compared to a profit of Rs 1.3 billion in the same quarter last year. The December quarter results were impacted due to high commodity prices coupled with subdued demand for replacement tires from transporters. However, the company has delivered good profit growth of 25% over the last 3 years. Also, it has been maintaining a healthy dividend payout of 19%. According to management's comments, it has decided to postpone the Rs 7 billion Phase 1 truck bus radial capacity expansion by 12 months, and the balanced Rs 5 billion of Phase 2 expansion has been postponed indefinitely due to market conditions and revised growth plans. The company is revising some of its capital expenditure programs. It aims to grow the businesses in 3 segments: two-wheelers, passenger cars, and off-highway tire segments. Apart from that, in the two-wheeler segment, where it claims a market share of about 30%, the company has also achieved leadership position in the electric two-wheeler category with a market share of about 60%. It's working with all the major electric two-wheeler makers. The stock has drifted lower since it hit its 52-week high of 1632 in March 2021. Currently, the stock trades almost 40% lower since then. With that, we come to the end of our list. How to deal with market corrections. One of the lessons financial markets have taught us is that the only guarantee is change. Just a few months ago, stock markets were riding high, smashing record after record, while today, the whole situation is entirely different. In volatile times like these, we must remember not to panic. The market will come through this phase stronger. Hold on to your long-term investments. To conclude, do remember that volatility is likely to persist going forward. So in this situation, don't make rash decisions and sell all your holdings. You might miss a chance of accumulating more of the same if you sell all your holdings when the markets are in a downtrend. And this would apply brakes to the process of compounding, considered to be the 8th wonder of the world. And that's a wrap. Thanks for watching. Happy investing. Take care. Goodbye.